and with the economy, and that the enthusiasm will not die down. And in fact, that we should expect to see a pretty dynamic summer ahead of us in terms of economic growth.
Yeah, and I think Pfizer just got approved for their vaccination for teens as well.
That's exactly right. In fact, I read the same thing this afternoon. Excuse me, I'm just reading an end of the a note. Yeah, the momentum. Yeah, that's great because it means that we'll be able to inoculate a whole of the population of the country safely. The concern still is, are the people that are opting out of the vaccinations. That is going to be a drag on any type of, I imagine, full recovery. But we're not just seeing it here in the U.S., we're seeing it around the world. And so our leaders need to do a better job of addressing the lack of confidence that exists in communities, not just here in the United States, but around the world, in order to beef up those vaccination rates, which have fallen off dramatically in the last week or two.
Do you think we'll be back at campus by fall?
Well, all I can tell you is that my understanding is from the university that the CUNY is going to be a mix of in-person, online, and hybrid type classes. In terms of my schedule, I'm teaching online in the fall. So,
Great.
well, I'm not so sure how great that is. I think that every professor, much like every student, would prefer to be in the classroom. There's really not much of a substitute for in-person learning. That being said, I think that we at Baruch and Zicklin have done an extremely good job of getting as close as possible to that classroom experience by being engaged and attentive and making the most of the technology that's allowed us to remain in contact. That being said, I want to move right on ahead with tonight's lesson. People will continue to come in. And this is we're at the, pardon me. We're in our last full week of classes. Yeah. I'm trying to get my slideshow in order here. Please just give me a moment. Aha, there we go. Okay, so at the end of class tonight, we'll talk about the final exam and other homework issues or administrative issues that I've making a note of. We're going to move forward tonight with a list of other hedging techniques.
Professor, are you recording?
Pardon me, am I recording? No, I'm not.
This is my girlfriend's little.
Okay, well, okay. Okay, let's hit that record button.
This meeting is being recorded.
Okay. Okay, so I'd like to take a look at what happened in the market last week. And as I said in the end of class, we'll talk about the final exam, some administrative things, including homeworks. We're going to talk tonight about first the markets, then we're going to move forward with non-deliverable forwards and a host of other products that global managers use regularly to address risk in the foreign exchange markets and currency markets, to neutralize or at least to minimize the foreign exchange risk we've been talking about since the beginning of the semester. So on Thursday, we got some very positive news. We got initial jobs claims report. As you see, the first jobless claims report on a weekly basis that fell below 500,000 claims for the first time since the pandemic began in March of 2020. It's extraordinary when you think that since March of 2020, every week there have been claims for unemployment greater than 500,000. That being said, the number came in, it was very strong. In addition, we got a very strong productivity number. What could account for the jump in productivity to 5.4%? Does anybody have an idea? What has this crisis forced all of us to do?
Be at home.
well, it's forced us to home, it's forced us to be at home, but it's also forced us to adapt. It's forced us to adapt. And in the process of adapting, what happens in the process of adapting? Innovation. And in the process of innovation, what we've seen is a pickup in productivity as people have adjusted to living in the digital world largely, when the physical world has become inhospitable. And we have made productivity gains, as seen here in the most recent number that came in last Thursday. So we had very positive numbers on Thursday in the job market and the labor market. And so the headlines were layoffs falling, hiring surging as the economy continues to gain strength, gather strength, and that iron ore prices had hit a record level last Thursday with steel demand far beyond expectations. We know that a lot of that demand for iron ore that comes out of Brazil, for example, is being made by China. We saw in April that copper prices are soaring. So we see that prices for precursor inputs, things like copper and steel, are rising, which is a reflection of what? The demand that manufacturers see just around the corner. So that's a very positive thing. And so on the heels of that news, the markets closed very strongly on Thursday, saying that the Dow climbed to a new record ahead of monthly U.S. jobs report with rising commodity prices suggesting strong demand. That was the headline in one of the financial items, one of the financial papers that I read that's cited on Blackboard, maybe from MarketWatch or Forbes, or maybe from the Wall Street Journal. Nevertheless, that was the quote. And the expectation is that the economy was going to show on the first Friday of the month, because we get the jobs report along with the unemployment rate, a jump of 1 million jobs having been created in the month before. So as you see, based upon the data that came out Thursday, we had a strong finish on Thursday. At the end of the day, what happened on Friday? On Friday, we got a very bad or dismal jobs report, which showed that instead of 1 million jobs being created, 266,000 jobs were created, and the unemployment rate, rather than falling, increased from 6 to 6.1%. So the headline was, it was the biggest miss relative to expectations in non-farm payroll since at least 1998. So clearly, and that's based upon the consensus opinion, so clearly something is up, something happened. In terms of the unemployment rate, the headline was that the report showed not just how far the economy had to go, but also that signs point to faster hiring ahead. We know that because of the demand at the precursor stage, where we see the demand for raw materials, inputs like copper prices and iron ore. What's the reason that the report was so weak? Can anyone give a thought as to why? One of the things that we talked about in here, we talked about supply chain bottlenecks. That's going to slow down some hiring in the manufacturing sector. What else can you think of as a reason that hiring hasn't been as robust last month as we thought it might be, along with the vaccine program?
I think some people who are saying this are right, that the stimulus may be keeping people at home for a little bit longer.
Okay. Well, it may be keeping them at home for a variety of reasons. It may be keeping them at home. Are you saying that the stimulus payments are keeping them at home? Well, the stimulus payments may be keeping them at home because they're looking to perhaps exploit an educational opportunity. It may be that childcare isn't available and they can't afford to go back to work. There can be a variety of reasons why people have not gone back to work, including the bottlenecks we've seen in the supply chains, the fact that there's an absence of thoroughly available childcare across the country for everybody. Excuse me just a second. I have a note that I'm looking for. So childcare, supply chain bottlenecks, and the evidence suggests otherwise, because we've seen that the civilian labor force has increased last month by 430,000 people. You would expect it to shrink if people were leaving the job market, but more people are joining the job market. There's also a mismatch between skills available and people. In terms of people not going back to work because of enriched unemployment benefits, the evidence suggests otherwise. That being said, the report came in much weaker than expected, but the general takeaway was by capital market makers was that it was a temporary thing, and that down the road, as we were discussing just before class started, certainly this summer we expect to see strong growth. And this last weekend is a barometer of the growth we can expect ahead. There was a surge in flying for Mother's Day weekend, higher than we saw just before the pandemic began. So clearly there's an enormous amount of pent-up demand that we're going to see expressed over the course of the coming months. Of course, there are drags, the vaccine pushback from some people, some blips that we'll see in terms of hiring with supply chain bottlenecks, and also people unable to find adequate childcare. Hopefully, Biden's various rescue packages will see some success and will deliver much needed solutions to many working class Americans that are in desperate need of support in terms of such things as childcare, access to better education, better skill building sources, etc. So that was what I wanted to go over with you here. Thursday, we had very strong market news with the expectation, labor market news with the expectation that that would continue on Friday with a strong creation of jobs through non-farm payrolls. That didn't happen. The market had a pause, but generally has come back to its positive line of thinking in terms of growth that we can expect to see ahead. The question I had for you was 10-year treasuries slid below 160 after the weaker than expected jobs report, which means that my question to you is why? Why would the yield be falling? We had a weaker than expected jobs report, which suggests what? It suggests that the Fed will continue to, that the Fed's right, that it's not a straight line to success, and the Fed needs to remain vigilant in terms of standing by its accommodative posture to support the economy through this difficult period as it looks to return to full employment. And so we had a much weaker than expected jobs number coming in, which on the one side reinforces the position of the Federal Reserve. On the other hand, though, in terms of investors and their concern, how does that translate into a falling yield?
So you're asking, how does...
They're buying more bonds, so
That's
the
exactly right.
price
Thank you,
increases.
Alec. They're buying more bonds. If they're buying more bonds, what's happening to the price?
Increases and the yield decreases.
Bravo, Alec. Thank you. Very good. Bad
Thank
jobs report. People pile into the bond market, drives down bond yields. That was excellent. Thank you. Thank you. Very good, everyone. Okay, so let's take a little bit look at let's look at the jobs report a little bit further. Okay, so what do we see? We see that before the pandemic, we were at 3.5% unemployment. Then we have this massive collapse in the labor market due to the COVID pandemic. Unemployment soars to 15%. So between then and now, we've lost just under 23 million jobs. We've gained 14.5 million jobs, which means there's a net of 8.2 million jobs that are absent in the economy that were there before. That's not even a gain on top of what was there in January and February of 2020. So again, another statistic that reinforces our confidence in the Federal Reserve's position about maintaining an aggressive, accommodative posture, supporting the quick resumption of economic activity on a path towards full employment. If we look here again, I mentioned the labor force participation rate. Now we know that the labor force participation rate peaked in the mid-90s under President Clinton. And since the end of the Great Recession in late 2009, beginning of 2010, we've seen the labor force participation rate, which is all the people that are in the job market actively working or actively looking for work. We've seen it trend downward, and we identified in the beginning of the semester some of the key reasons why it's trended downward, including record college enrollment, baby boomers retiring. Those are people that are born between 46 and 64, so people in their late 50s, early 60s, the Great Recession, pardon me, the COVID downturn, and of course, resource reallocation. What do I mean when I say resource reallocation?
1%.
Pardon me, Maria?
To the 1%?
Taxes?
In terms of the labor force, what's happening in the labor force at the same time? What's happening in the labor force during this time, among other things? What trends are happening? Automation, outsourcing, automation, outsourcing. Along the same time that people have left the labor force, you've had back-to-back major economic crises, and some people have literally checked out of the labor force. We see that as the COVID pandemic begins in the start of 2020, LFPR gets a real kick and really plummets. We see here, but again, since the depths of the COVID-driven recession or the pandemic, what have we seen? We've seen it's come back. And last month we saw an addition of 430,000 people in the labor force, which takes away some of the argument that people are just sitting at home waiting because they're getting more money. The truth is that what we find when we do surveys is that people would rather go back and get a job and forgo some of those additional benefits, because those benefits, what is it about those benefits?
They end.
They have
Ta-da!
bad connotations.
They end. The benefits end. The benefits end. And so the overwhelming evidence is that people would prefer to work as opposed to relying on those enhanced benefits. That's not to say that nobody does, but again, the evidence is suggesting otherwise. And among other reasons, we see what happened with labor force participation last month. So moving along, I want us to look at the inflation rate, because a lot's been said about the inflation, the worry about inflation. So look where inflation was right before. Why are we doing this? Let me pause for a second. We're doing this because as global managers, we want to have a sense of what the U.S. market is doing, the U.S. economy is doing, because so as goes the U.S. economy, so goes the rest of the world. If the U.S. economy recovers, next will follow Europe, next will follow Japan, and next will follow the rest of Asia. And so the U.S. is a bellwether for the rest of the global recovery. And so we want to know as global managers, what is the Fed going to do? What will interest rates look like? What can we expect to see from this singularly important central bank and government over the course of the next time frame in order to adjust our plans for whatever it is our business activities are? So as you see here, the inflation rate at a point when we were at full employment, 3.5% unemployment in the beginning of 2020, we were at 2.5% unemployment. Then what happens? Unemployment plummets. And the headline today was, "The recovery stumbles leave Americans confronting unfamiliar inflation risk." That was in the headline of the New York Times today. And so the question I have for you is that right? Is that right? Or is the fact that there was no inflation disappeared as a result of the COVID pandemic? And now we're starting to see a return to some inflationary pressure, some upward pressure on prices that is exactly consistent with what? A strengthening economy. Doesn't that seem right to you? In other words, I didn't. Why don't you share them with us and tell us what the CPI numbers were? You're talking about CPI numbers that came out today? Oh, no, I don't have the CPI numbers today. I don't have them in front of me, but we'll bring them in on Wednesday. In fact, yeah, because there was nothing today in the big economic news today. In terms of the CPI right now, it says, well, that's wrong. Right, CPI as of March, CPI of March was 1.6%. So not very high. It's 1.6%. That's the core CPI. That's less food and energy, which are more volatile. The point is that it's much ado about nothing, which is about quoting Shakespeare. Now, we saw last week how Janet Yellen let spill that maybe there'll be some upward pressure on prices at some point down the road, and the markets really took a tumble. She had to clarify those comments to reconfirm exactly what Jerome Powell has been saying now for months, which is Yes, at some point in the future, but for the time being, there's no reason to start talking about tapering, no reason to talk about hiking interest rates, because the economy is still in disarray, and it's going to take us a while to recuperate from. If you just look at this, you see the scope of what's happened. Look at this jobs report here. This is extraordinary what happened. And so the recovery that we've made so far is pretty phenomenal, but clearly we have a ways to go. So here we see US inflation, strengthening economy. Now look at inflation on the chart below since 1995, over 25 so years. What do you see? You see that between the Great Recession ending in 2009-10, the end of 2009, beginning of 2010, the COVID pandemic, inflation rarely goes above 2%. Yes? During all of that time, inflation has barely gone above 2%. At the same time, we see that wages and salary growth since the end of 2010 has barely been above 5% in the last 11 years. At the same time, if we look at the Dow over 25 years, but focus on the period since the end of the recession, June 2009 or July 2009, beginning of 2010, where's the Dow gone? It's more than tripled in the same period of time. So we're going to talk a little about income inequality over the next couple of sessions here and there. But to round out our discussion about this that we began at the beginning of the semester, but this is a good illustration of that. We see a disconnect between the growth in salaries and wages as opposed to the growth in the stock market. Okay. So when we talk about international banking, we know that the trading day begins in Tokyo and Sydney, moves around the world, as you know, in 24-hour cycles. London and New York are by far the largest foreign exchange markets. The average daily turnover in foreign exchange markets is about $5 trillion. Now we know that exchange rates are brought into harmony via exchange arbitrage. What does that mean? It means investors, speculators, individuals, companies, all buying and selling currencies until currencies come into harmony through exchange arbitrage. So let's take a look at an example here of exchange arbitrage like we've done before. Everybody should get out their calculators. So I'm telling you that the euro pound was $1.3021. The dollar euro was $1.1523, and the dollar pound was $1.5028, 5028. So I want you to tell me, what is the euro pound calculated cross rate? Can anyone tell me that quickly? How many times does the euro go into the pound?
Is it 1.01?
No. No. Can somebody else tell me? But good shot, good guess.
0.7668.
Folks, these are simple cross rates. We've done this quite a few times. How many times does the euro go into the pound? So you have to say 1.5028 divided by 1.1523 because they have in common the dollar, which we can eliminate, the common factor. And we say that the calculated cross rate is euro pound 1.3041. So if I know that the spot rate of euro pound is 1.3021 and the calculated cross rate is 1.3041, we know we have a mispricing, which leads to exchange arbitrage, in our case, to triangular arbitrage. Does everybody understand how we got the calculated cross rate? It's important that you know that. Okay, so we know that there's market mispricing. So if the firm has $1 million, what are they going to do? They're going to sell dollars for euros, euros then into pounds, and then pounds back into dollars. So let's calculate it through. Our triangular arbitrage. Well, 1 million times the 8678 gives us the 867,800 euros, 867,800 euros. We're going to sell those for pounds at 1.3021. Those euros are going to give us pound 666,461.87, which then we're going to sell for dollars at 1.5028, which gives us 1,155,890, which gives us a profit of $1,558.90. So very straightforward example like we've done before, but gives us an opportunity to illustrate once again exchange arbitrage, which is talked about in chapter 11, the homework for which I'm going to ask you to complete. I'm going to assign to you this evening. I wanted to put this in here. When we talk about stabilizing speculation goes against market forces. So if suddenly the dollar is falling, well, then speculators will buy the dollar, expecting that the dollar will recover soon, and therefore there will be a profit for the speculator to make. What stabilizing speculation does is it moderates or reverses changes in spot rates. So as I said, speculators are going to buy foreign exchange when it falls with the expectation that it will rise in value and generate a profit. It goes against market forces, as opposed to destabilizing speculation, which goes with market forces. Excuse me. This just exaggerates or reinforces the spot rate changes. So if the dollar's falling, what are speculators doing? They're selling the dollar to weaken the dollar further. So speculators are selling the foreign exchange with the expectation it will continue to fall in value. So it becomes a self-fulfilling prophecy. In markets where we oftentimes see this type of condition is in destabilizing speculation, is in the housing markets, right? There's a buying frenzy, sending prices soaring. Or in the oil markets, we see oil prices collapse in the beginning of 2020. They go negative. West Texas Intermediate goes negative. So again, these become reinforcing or self-fulfilling. Are there any questions on here before we move on?
Yes,
Yes, Professor.
yeah.
Sure.
You can go, Maria, and then I'll ask.
The only question I got, Professor, where did you get the 0.8678?
Me too. I have the same question.
Where did I get, excuse me, what?
The dollar sell for the euro. 0.8678.
Yes.
Oh, number one, when the firm is selling 1 million euros.
1.1523, we just take the inverse exchange rate of that. I just took the inverse exchange rate of 1.1523 because I have
the inverse. Oh.
Pardon me?
So we did 1 divided 1.1523.
I get a different number.
It's just the inverse. You need to do 1 divided by 1.1523 and you're going to get the answer.
Oh,
good.
Okay, I see.
Good. Thank you very much. Thank you very much, Sahara. Okay, so let's move on then. Thank you. I want to talk about non-deliverable forwards. We've alluded to this a number of times. What do companies do when there's no deliverable forward market? This is a list from the International Monetary Fund. You can get the same thing from the CIA. It's a list of countries that currently have in place, among others, that have in place capital controls, where there's some type of limit or complete, or some type of limit or a complete stoppage of the forward markets. And so back in the early 1990s, some clever folks downtown here on Wall Street came up with an idea to create a product that would allow companies to get around capital controls. And so what they came up with was non-deliverable forwards, which is effectively an over-the-counter product. It's a short-term cash-settled currency forward. It's always settled in US dollars. Okay, again, it's a product that we use where foreign exchange has been banned or restricted. As I said, it's a short-term, over-the-counter, cash-settled currency forward. It's always settled in dollars. It's an off-balance sheet transaction, which is important for multinationals. And what it allows companies to do is to lock in their accounts receivable or lock in their accounts payable. I'm just going to sketch out for you what the mechanism is and how it works. There is a contract rate at origination. That contract rate is the value of the accounts receivable or the cost of the accounts payable. Now, the currency may strengthen or fall during the time period. So that means that the company may receive a lower value or pay a higher price. With NDFs, that's not what happens, because once the contract rate is set, whatever the spot rate is, origination establishes the contract rate, we compare that value to the value at maturity. And if the value at maturity goes against the company, well, then the company is going to be reimbursed by the bank. If the currency goes with the company, well, then the company will reimburse the bank. The point is that the company will not pay more than what its accounts payable was at origination, and the value that it receives won't be less than the value that was established at origination. So let's take a look at the various elements. As I said, you're going to compare cash flows based upon the contract values, the dollar contract value at origination and maturity. And of course, again, it minimizes translation and convertibility risk, and you're dependent on local markets. So the elements include the currency and the settlement date, the notional principal, which these are all elements everybody is familiar with in this class, your reference rate, your strike rate, your contract rate. As I said, it's your spot price at origination, which becomes your benchmark value with a receivable or what you're going to pay with a payable. You have the fixing rate or the settlement rate, which is a spot price at maturity. Typically, if you're working in developing or frontier markets, the spot rate, there might not be a regular capital market in place. And so the spot rate at maturity comes from the central bank or whatever the region is or the country is that you're doing business in. Okay, and we look at the dollar value position at origination versus the dollar value position at maturity, much like I said. And finally, that the settlement or fixing rate, the rate at maturity is typically found with the prevailing central bank rate. So let's go ahead and take a look at an example then. So here in this case, the company had accounts payable of, in 6 months, of Thai baht 35 million, and they wanted to lock in its costs. And so what the NDF is going to allow the company to do was to lock in its costs based upon the spot rate at origination. So it's not going to pay any more, but at the same time, it's not going to pay any less. And in either case, if there's a reimbursement to be made, either the company to the bank or the bank to the company, it's always going to be settled in US dollars. Okay? So in this case, the company fears that the baht will strengthen, but there was no deliverable forward market, so the firm entered into an NDF. The spot at origination was 0.0314, which translates to a cost a little over $1 million. Anyhow, if the currency, we've got two scenarios: the currency strengthened to 0.0392 or the currency weakened to 0.0289. At origination, the value of the payable is $1,000,099. So the company, by entering into the NDF, knows it's not going to pay more than the $1,000,099, which is great, which is the very foreign exchange risk it's looking to neutralize. At the same time, though, because it's an NDF, they won't pay less. Okay, so if at maturity the currency has strengthened and the payable, the size of the payable has increased from $1,000,099 to $1,372,000, well, the company still owes the money, right? But they're going to be reimbursed by the bank $273,000 to make up the difference in US dollars. On the other hand, if the currency weakens and the size of the payable falls to $1,011,500, well, in this case, the company is going to pay the bank the difference, the $87,500 that the firm then pays to the bank. Are there any questions here? Okay. Well, then let's go on and do another problem. Here's a company of a This is a company that's not far from Hudson, New York. So it's an upstate New York lighting manufacturer that had a 6-month payable of Malaysian ringgit of 1.63 million, and they wanted to lock in their cost. Of course, what's their fear? That the ringgit will strengthen. Excuse me just a second. That the ringgit will strengthen, but there was no liberal forward market to buy the ringgit. So the company entered into an NDF agreement along with the help of a very able global manager. So the ringgit spot was 23 cents and change. You've got two scenarios: the ringgit strengthens to 27 cents and change, or the weaken, or the ringgit weakened to 0.2099. This should say TN2 MYR, which is Malaysian ringgit. We'll correct that before I post it. So the contract value at origination we know is 376,041. That means that the Hudson Valley Lighting Company is not going to pay any more than that for their payable. They won't pay less though. So if the currency strengthens, well, then the payable becomes 454,933, in which case the bank will reimburse the firm, which is still obligated to pay the to make due on the payable, the 78,000 and change that is in excess of the contract value at origination. And finally, if the currency weakened, well, then of course we know that the company is going to pay the bank the difference against the contract value at origination, which is 33,904. So in both cases, we saw two companies that were able to non-deliverable forwards in order to address currency controls that prevented them from hedging their exposure, accounts payable or accounts receivable, pardon me, in a foreign market. These are very, very commonly used all the time, much like interest rate swaps, in order to handle this type of foreign exchange risk, which is oftentimes seen in markets where we see a lot of outsourcing. So it's very common. Now, I'd like us to turn our attention to interest rate caps, which is another type of product that is very helpful for companies that have any type of floating rate financing. It's like a call option on interest rates, and it's used to hedge maximum cost. GMP means guaranteed maximum cost or guaranteed maximum price. It's called the knock-in option. Why? Because it's triggered when a strike price or price level is reached. So again, like I said, it's a call option on interest rates that limits costs. The buyer is going to receive a difference between a reference rate and a strike price against a notional principal amount. Excuse me. Okay. The elements for interest rate cap are as follows. There's the interest payment, there's the cap cash flow, and there's the premium payment. So let's say you're a global manager working in finance for a multinational that has taken on $3 million in floating rate debt, but you expect interest rates to rise. Well, you're going to want to make sure that you have some type of hedge in place in order to protect against what will be higher costs as interest rates inevitably will rise. One of the ways to do that is with this product, the interest rate cap. So let's take a look at an example. So here, the company had floating rate financing and wanted to hedge its costs naturally. The notional was 3.95 million. The term was 5 years. The premium, the cost, was 102 basis points. The strike rate was 4.25%. What does that mean? It means that the company wants to enter into a contract that is going to ensure that it's not going to pay more than 4.25%, okay, over the course of the next 5 years. In this case, the reference rate was 3-month LIBOR. That means there's going to be a payment made every quarter. And the periods were 20. Why are there 20 periods? Can anyone tell me?
Yeah, 20 quarters in 5 years.
Thank you, Sahar. He's absolutely right, everyone. Listen up. 20 periods over 5 years, 4 periods per year. Excellent. So The question is, if 1-year rates rose to 586 in the first period, calculate the cash flows. Well, the interest payment is the notional principal times the fractional part of the annual rate, or the quarterly version of the annual rate, of 586, which gives us 57,868 is the interest payment. So the company has made the payment, but they're going to get paid, reimbursed from the bank. That's their cap cash flow. So the cap cash flow is the difference between the spot rate and the reference rate multiplied by your notional principal amount times the relevant fraction of the year, your quarterly rate here, which gives us 15,899. So think of that. The company paid 57,868. They get back 15,899 because of the interest rate cap. Now, if we want to figure out what the return is for the period, we need to take into consideration the premium cost. Now, remember, the premium cost is paid up front. So we have to amortize the premium cost over those 20 periods. So the cost of the premium was 102 basis points on the 3.95 million, which came out to 40,290. The per period cost, though, was 2015. That's very important that you take that into consideration, or it's going to mess with your calculations. So again, we need to amortize the premium cost over the relevant number of periods, which we determine based upon the fact that it's a quarterly payment, it's 5 years, there are 4 periods of year, which gave us 20 payments, as explained to us by Sahar. So what then is the net cost to the company? The company paid 57,868, it received 15,899, and it paid the amortized portion of that premium payment, the 2015. So that means that its total payment was 43,984 for that first period. We want to look at what the cost would be on an annualized basis. So what do we need to do? We need to multiply that quarterly rate times 4. Because what does that say? What that says is, well, if things go exactly the same way over the course of the next 3 quarters, this is what my annualized cost would be. So we multiply that by 4, the 43,984. We get 175,936. If rates do exactly the same thing over the next 3 quarters, this is what's going to be our annual. This is what's going to be our annual cost or interest cost, right? If we divide this by the notional principal, it means that our overall cost was 445. Our implied cost, our implied annualized cost for the quarter was 445, which is versus the 586. So that means what? That means we saved 141 basis points on 3.95 million, right?
Yeah.
Which is another $55,000. So having the cap was a very smart idea, and is something that you should add, a quiver that you should add to your archery kit. You know, a bow and arrow, because it's a very powerful product, much like non-liberal forwards and all the other products that we continue to explore. So,
Professor, should we discount each year's saving into a present value?
in order to get the cap cash flow?
Yeah.
No, because all that we're doing, well, that's not really what you're asking. You're asking, in other words, the interest payment is the interest payment. The cap cash flow, you're comparing a strike and a reference rate versus a spot price on the notional principal. The premium payment, you're amortizing it over all the periods. What you're asking is about down here, whether or not you need to take into consideration the discounted value. No, you don't. We're just saying this is how the market performed for one quarter. If it performs the same way over the next 4 quarters, what's the implied cost? It's exactly right.
Professor, I have a question, sir. Why do you multiply by 4 and how do you
Because you have one period, 1 quarter, in 1 quarter, 1 3-month period, the performance was, our net interest payment was 43,984. It's what we paid on interest, plus the amortized cost for the premium, plus everything we were reimbursed as a result of the interest rate cap. So
Okay,
the
so
cost for the quarter was 43,984. If the markets perform exactly the same way for the next 3 quarters, representing 4 quarters over the course of a year, that's how we get the 4. Do you understand?
okay, because it was only 1 quarter, you said?
That's right. For
Okay.
1 quarter. In other words, it's a 3-month period. We say it's 3-month LIBOR. There are 4 periods per year, so 20 periods. We multiply it by 4 because this says, well, if the markets do the same thing over the next course of the entire year, well, this is what our cost would be.
Okay, and how do you get the 140 base points then?
Because 586 minus 445 is 140 basis points, or 1.4%.
Okay, thank you.
You're welcome. So now let's talk about interest rate floors. You can use an interest rate cap to establish a maximum cost. You can also use an interest rate floor to establish a minimum return. So it's like a put option on interest rates, which set a minimum return. Now, there are 3 elements here, much like there were with the cap. You have a yield, the interest yield, you have the floor cash flow, and you have the premium payment. Let's take a look at an example here from a firm that has a cash flow from an asset sale. They want to hedge the return on the asset sale. So the notional principal was 1.35 million. The term was 4 years. The premium was 76 basis points. The strike rate was 620. In other words, the company doesn't want to earn less than 620. The reference rate again here was quarterly or 3-month LIBOR. So that means we're going to have 16 periods, right? 4 periods per year times 4, 16. The question is, if relevant 1-year rates fell to 505 in the first period, what are the cash flows? Well, let's take a look. The interest yield, as opposed to the interest payment, is 505. A quarter of 505 multiplied by the notional principal gives us a return of 17,044. The floor cash flow is the difference between the strike price, the 620, less the spot rate, multiplied by the fractional part of the year times the notional principal here, gives us 3881. So we received 17,044 plus 3881 as a result of the floor, the interest rate floor. But now we have to take into consideration what? The premium. So the premium cost was 76 basis points on the 1,350,000, but the cost of the floor was 10,260. The per period cost of the floor was $641. Okay, so now let's see. The company received the 17,044 from its yield. From the floor cash flow, it got 3881. Its period payment, or the payment for the period for the premium, the amortized payment was 641. So that comes out to a total of 20,284. We do the same thing that we did with the interest rate cap. If the markets perform the same way over the next 3 quarters for the whole year, well, then that means we will have generated a return of 2284 every quarter. That gives us a total of 81,360. We divide that by the principal of 1,350,000, gives us a return of 6.01% versus the market return, which is 505. So that means that we get 96 basis points more than we would have gotten if it wasn't for the interest rate floor. Okay.
Professor, so this is what we are the minimum return that we are requesting.
That's exactly right. That's exactly right.
And I'm sorry, could you please repeat what was the interest rate cap was?
You saved $12,960 here. The interest rate cap is a call on interest rates. In other words, it's a guaranteed maximum price.
Maximum. Thank you.
It's a guaranteed maximum price. Okay. So here, yep. Hey, that's exactly right. Interest rates stay exactly where they are. That's exactly right. Okay?
Good.
Good. Thank you, Andrew. So let's take a look at another example. Here, a company has an asset sale of 4.35 million. They want to insulate the downside risk of lower returns, and they decided what? To buy an interest rate floor. The strike rate was 650. The reference rate here was 6-month LIBOR, so only 2 periods per year. The premium was 89 basis points, and the term was only 3 years. So if rates fell to 505 in the first period, I say decompose the cash flows. When we talk about interest rate caps and floors, the terminology is to decompose the cash flows. So I say decompose the cash flows and identify the company's implied ROIs we've been doing. Well, let's do the solution. The interest yield is 1/2 of the 505 multiplied by the 4,350,000 gives us a yield of 109,838. The floor cash flow is the difference between the strike price and the spot price times the notional times the 1/2, which is a fractional part of the year, gave us 31,538. Now we have taken into consideration the premium of 89 basis points, which is 38,715. Allocated or amortized over 6 periods equals 3 semi-annual periods. Gives us an implied cost per period of 6,453. So in this first period, the total to the company was 109,838 plus 31,538 minus the 6,453 gave us 134,924, which we multiply by 2 to extrapolate it for the full year, divided by the notional principal amount, gives us an implied return on investment for the period on an annualized basis of 620 versus 505, which is 115 basis points on 4.35 million, which is a very nice savings. Right. So the company picked up another 50 grand. Any questions here?
Professor, for the premium payment, this when you divide by 6 is because of the 3 years, right?
The premium payment, yes, of course, because there are 2 periods per year times 3 years is 6 periods.
Okay, perfect.
Okay, in other words, you're charged, you paid 38,017 up front, but you want to come up with return, you want to look at your return on investment on a per period basis. Well, in order to do that, you need to amortize the payment over the total number of periods. Does that work? Yes?
Yes.
Good, thank you very much. Okay, so that's all very good. Let's move on then. We did caps, floors, non-livable forwards. Let's talk about currency straddles. Okay? Currency straddle, the company holds both put and call options with the same strike price and the same expiration date. Okay, again, the company holds both put and call options with the same strike and expiration date. Why would a company want to straddle? Anybody?
Is it to hedge the call option against the put option?
It's against volatility.
Pardon me?
It's against huge volatility in the markets.
Against volatility? I thought that's a good answer. I like the answer. I liked all the answers. I thought the answer that said they don't know whether it's going to go up or down was really hitting the nail on the head. You don't know whether you're going to have a receivable or a payable. So let's take a look. There's a company out here in Brooklyn I've worked with over the years. They're a furniture manufacturer that imports wood, beautiful wood from Morocco. They had outstanding Moroccan dirham payables of 2 million due in 3 months, as well as a possible sale in 3 months of dirham 4 million. So now you understand how thinking comes together about a currency straddle. I need to be protected on the upside and I need to be protected on the downside. I think it was Andrew that said that. So the company is going to use a currency straddle to hedge its transaction risk. So if the sale is successful in the 3 months, put options will allow the company to hedge its dirham receivables of 2 million. If the sale is unsuccessful in 3 months, the company has call options to satisfy its payable of 2 million. So
50-50.
the company is outstanding, it owes 2 million and might have a sale of 4 million. So if it has a sale of 4 million, then it's got to convert 2 million, it's got to net 2 million. So it's either going to net 2 million or it's going to owe 2 million dirham. Does everybody understand?
What would be the cost though?
We're going to talk about that.
Professor, but it also says that they expect a high volatility because they need to cover 2 premiums.
Right, well, we're going to account for the premium. So let's have a look. Okay. In other words, this is an actual set of facts. The company knew that it owed 2 million and may or may not have a sale in 3 months, the same time frame, the end of which it owes the 2 million. So it's going to be up or down 2 million dirham. And so enters into a straddle in order to hedge the risk on the upside with the receivables or on the downside with the payables. So every dirham contract controls 500,000 dirham. So the company needs to buy 4 options and 4 call options, 4 puts and 4 calls, because that would control 2 million dirham in either case. So either it's going to be up to or down to. So any questions as we go through, let me know. So let's look what happens if the sale is successful. So let's put out the basic data. In this case, the call and put strike price was 9.8 cents, 0.098. The call option premium was 0.003 cents per unit. The put option premium was 0.002 cents per unit. I told you already that the dirham contract, each one controls 500,000 units. Therefore, they're buying 4 puts and 4 calls. At the time the trade was put on, the dirham spot was 10 cents. The company was able to generate with its manager 3 potential scenarios for spot rates in 3 months. The dirham was trading at 9.8 cents, 8 cents, so weaker, or 11 cents stronger. Let's see what happened. So if the dirham at maturity is at 9.8 cents, what does that mean? It means you have an at-the-money call and an at-the-money put, right?
Yeah.
So what's the company going to do? If the sale is successful, so it has 2 million dirham, it's a net cash flow of 2 million dirham. It wants to convert that dirham at the highest possible price, right? So if the dirham spot is 9.8 cents, it doesn't need the options. They're at the money calls and puts. You don't need them.
Yeah.
Right. So the company's going to convert in the spot market at 9.8 cents, right? And so the potential cash flows, the put and call options are going to expire. So it's converting 2 million at 98 cents. It's got to subtract the cost of the
Premium.
It's got to subtract the cost of the premium, which is the 3 cents plus the 2 cents times the 2 million, generates a possible net cash flow at a price of 9.8 cents of 186,000. Now let's say that the spot rate was 8 cents. Well, if the spot rate is 8 cents, well then the company's going to want to use its put options to convert, right? It's going to want to use its put options to convert. The call options are worthless, so therefore the call options are worthless, so we can let those expire. So you have an in-the-money put and an out-of-the-money call. So you're going to put them at 9.8 cents, less the premium gives you, the premium cost gives you 186,000 as possible net cash flow. What happens though if the currency strengthens? Well, if the currency strengthens, you're going to want to convert at the highest possible price. So you're going to convert in the spot market, because here you have an in the money, call and an out of the money put. You're going to convert in the spot market, and then what? You're going to use the call option because you can buy at 9.8 cents and you can sell in the spot market at 11 cents, right? And that additional money that you can make exploiting the value of the in the money call while still converting in the spot market allows you to do what? Reduce your overall premium cost. So you're letting the put options expire. As I point out here, the company's going to exercise its calls, buying dirham at the strike price of 11 cents and selling in the spot market. No, buying dirham at the strike price, pardon me, if you don't want to make that mistake. At the strike of 9.8 cents and selling dirham at the spot 11 cents, which allows them to recapture some of the premium costs. So look, they sold 2 million 11 cents. They make the difference on 2 million against the notional principal of 2 million dirham against the difference between 11 cents and 9.8 cents. They used the call to buy at 9.8 and they sold 11 cents. And then of course you have to take into consideration the premium, and you get up, you come out with $234,000. Okay? So now let's take a look at what happens when the sale is unsuccessful. The same data still holds. So we want to know if the sale is unsuccessful, what do the cash flows look like at those three, under those three scenarios? Well, at 9.8 cents, again, you have an at the money put and an out the money call, right? And so what are you going to do? You're going to convert in the spot market and let the options expire. Yes? And so you've got 2 million times 9.8 cents plus the cost of the options gives you a cost here of 206,000. If the dirham spot though is at 8 cents, what have you got? Is it an in the money put or an out of money put?
In the money put.
It's an in the money put. It's an in the money put. Is it an out of the money or in the money call?
Out of the money.
Out of the money.
It's an out of the money call. That's exactly right. So you're looking to convert at the lowest possible price. So you're going to convert in the spot market at 8 cents. But what are you going to do here? You're going to buy at 8 cents and you're going to sell them using the put option at 9.8 cents. Yes, you can buy in the spot market and sell them by exercising the put. So you got 2 million at 8 cents multiplied by the profit you're picking up by exercising your put option, which is you're buying it at 8 cents in the spot market, you're selling it at 9.8 cents, and then you take into consideration your premium cost to generate a return of a cost, pardon me, not a return, a cost, because the sale was unsuccessful, of $134,000. Now, what happens if the dirham is 11 cents? Well, if the dirham is 11 cents, well, what are you going to do? You want to convert at the lowest possible price. Somebody tell me what you're going to do.
You have in the money call, right?
Yeah,
You have in the money calls. So you're going to convert at the call price of 9.8 cents. You can convert using your call options, let your put options expire. So you're converting at 9.8 cents as opposed to 11, taking into consideration your premium costs. That gives you a cost of $206,000. Okay. So if we look here, we say, let's summarize. You've got three different spot prices: par, weaker, stronger. Here the sale is successful. You have dirham revenue of 2 million. Here the cost is, the sale is unsuccessful. You have dirham cost of also 2 million. So what do we see? We say that when the sale was successful, The put option, as you see here, protected us against a drop in the value. The put option protected against a drop in the value of the dirham, right? When the sale was unsuccessful, the call option protected against a rise in the value of the dirham. Hope everybody sees that. Okay? Okay. So here's what I want to do. Just bear with me for a second, folks. Just bear with me for a second. Okay. Okay. Just bear with me for a second. I'm coming back. Okay. Now, okay, I'm coming back. Just bear with me for a second. Okay. I can't seem to do what I'm trying to do here, which is trying to just rearrange some slides. Just bear with me a second. I seem to be getting there. I know we're tight on time. Okay. I think we're okay now. Yeah. Okay. Okay. So I want to talk to you about, we're not going to get to, we did straddles. We're not going to get to strangles tonight. We'll talk about strangles on Wednesday. Currency strangles, that is. We have the same expiration date but different strike prices, which leads to a lower premium and potentially a higher yield. But we'll talk about that on Wednesday. It's a less expensive option for companies that are looking to hedge the risk we just talked about with the Moroccan dirham, but a lower price. And we'll talk about that on Wednesday, along with we'll do leading, lagging, parallel loans, factoring. We're going to do a little bit of work on multinational capital budgeting on Wednesday. That'll take us into Monday, and we'll talk about the final again, and then we'll have our exam on Wednesday. I wanted to talk to you about a couple of things. As of this evening, I'm assigning to you Chapter 11 homework. Everybody should do that. There are questions it's not all the questions, it's only some of the questions. It's in the syllabus. Please follow the syllabus. Excuse me. Oh, I'm sorry. I disappeared. I didn't realize the camera wasn't on. Please follow the syllabus, do those questions. And I'm going to post answers to the Chapter 11 questions on Wednesday afternoon. They're easy. You should knock them out and do them on Wednesday, because then on Thursday, I'm going to post for you another hedging homework. The answers to the hedging homework that went up last week were posted this morning. I've had some questions about them. I was happy to respond to those. I'll respond to others as you bring them to me. You get another hedging homework on Thursday that you'll do over the weekend. And on Monday, we'll have some cleanup and some review. In terms of the final exam, I'm going to ask you questions about welfare effects, but I'm not going to ask you to plot welfare effects other than those of regional trading relationships. So that's something that you want to focus on. There will be a series of questions on welfare effects for regional trading relationships. So I would mark that down as something that you want to focus on. I will ask you questions, theoretical questions, and concept questions, conceptual questions, of course, in the true false. But in terms of plotting welfare effects, that'll be regional trading relationships. And then, of course, all of the hedging. I am writing the exam. I will continue to come back with you comments on Wednesday, also on Monday. Looking at my notes. Also, if you would do me a favor, please, and if you can find 5 minutes in your day, I know everybody is super busy. I'm very respectful of your time. But to fill out the evaluations for the class, I've gotten a couple of notifications, and it's been a little slower than we had hoped for. If you have 5 minutes, so please go on and fill out the evaluation for this class. I would appreciate that. Of course, some of you have given me constructive feedback throughout the semester, which I'm always grateful for and appreciate and try to incorporate into my teaching. That being said, the school likes to collect some data. So again, if you have a few minutes to go on and fill that out for this class, I, along with the administration, would say thank you very much. So with that, I want to wish you all a good continuation of your evening, a good, safe continuation, I should say, a good day tomorrow, and I look forward to seeing you all on Wednesday evening, okay?